Well, good afternoon, everybody, and thank you very much for joining this this webinar on inheritance tax, how we might reform it, what we might do with it. It comes off the back of a fantastic report, which you will find on the IFS website by my colleagues Arun, Advani and David Sturrock, who will be speaking in a moment. Very well timed, as you will note, as the speculation was rife over the weekend that that somewhat zombie policy brought up now and again that we might want to abolish inheritance tax was floated once again. As I say, I very much commend to you the report. There's lots of detail in it, but most of the big points will be covered in the conversation today. One sad bit of news is that I'm afraid we're not going to be joined by Emma Chamberlain. There's been some serious, I'm afraid, illness in her family, which means that she's not able to join us. And she would have covered some of the aspects around trusts and non-doms and so on that we cover only rather briefly in this report. So my apologies for that, but that was unavoidable and at the last moment. I should thank very much the Nuffield Foundation, who have funded this work as part of our annual Green Budget, our pre-budget publication, or in this case, pre-autumn statement publication, at which we look forward to some of the options for the Chancellor in the forthcoming fiscal events. There'll be several more of these reports coming out over the next few weeks, looking at everything from corporation tax to the state of the public finances. So do look out for those. The way this is going to work is that, first of all, Arun Advani will speak. He is an associate professor at the University of Warwick and a research fellow here at the Institute for Fiscal Studies, and he'll talk about how inheritance tax works and some of the reform options. And then David Sturrock, who's a senior economist here, will talk about some of the implications and particular distributional consequences, some of the reform options that we're looking at. This is an opportunity very much for you to ask questions. You should all have access to Slido. I can see there's already a question or two up there. Do put your questions on Slido and vote up the ones you would like, because they're the ones I will see first, the ones that have the most votes. We'll have plenty of time for questions and answers. If because Emma isn't here, we finish a little bit early, that's also absolutely fine, but we have until 3:15 if we need it. I will stop there and hand over to Arun.
Thanks very much, Paul. So as Paul said, this presentation is based on this new report that David and I published this morning. And we were sort of thinking about the issues around inheritance tax, partly because we know that inheritance tax is often reported as being quite unpopular. And there are different reasons why some people dislike it. You know, on the one hand, there are people who say inheritance tax is just too easy to avoid. Inheritance tax doesn't work very well. You know, rich people don't pay it enough, and therefore they want to make changes that will remove some of those exemptions that lead to that being the case. At the other end, there are a set of people who say inheritance tax is sort of inherently unfair. You shouldn't tax the transfer of assets from me to my kids or to whoever I want to give them to, and so we should just abolish the tax. And there's, you know, as Paul said, there's clearly been a lot of recent media speculation about whether some sort of reform, more likely along the latter line of abolition or restriction, is coming. And so what we wanted to do was to think about what are the trade-offs that are inherent in any choices around reforms. What are the choices that you're going to have to make when you think about it? What's going to happen if you do a reform either to expand or to abolish or to do something in between that, you know, is maybe restructuring to adjust some of the bits of the tax at the moment. So what I'll talk through is first, you know, what will happen to inheritance tax in the absence of reform, and then we'll talk a bit about what that does in terms of raising money or costing money for different kinds of reforms. And then I'll hand over to my colleague David, who will talk us through, you know, what are the benefits from doing these different reforms, who's going to benefit, which groups benefit in different kinds of ways. So first, let's just think about what inheritance tax looks like right now, without doing any reforms, just the status quo. How does it work, and what will happen if we do nothing at all? So just some background, some of you will know this, but just as a kind of primer, this is very high level. The basic way that inheritance tax works is that there's a 40% tax rate on wealth that's passed on from the person who died to whoever they're giving it to, for all the wealth that's above a tax-free allowance. So a certain amount that's tax-free, above that you're paying a tax. And that basic allowance is actually a bit complicated. When you pay income tax, it's very straightforward. There's a personal allowance, it's pretty much the same for everybody. Here is actually, there's a few different moving parts. And so first there's the nil rate band. That's the sort of technical name for the standard allowance that everybody gets. Everyone gets £325,000 they can pass on tax-free to whoever they want. On top of that, there's this thing called the residential nil rate band. It's a special allowance if you're handing on houses specifically, and a house that you've lived in particular, and you're handing that house to your kids or your grandkids. So it has to be to a direct descendant. If both those conditions are true, the wealth you're passing on is from a house and it's to your kids or grandkids, then you get an extra £175,000 that you can cover up as long as the value of the house is worth at least that much. Then on top of that, there's actually because if one person dies, they might want to eventually give the assets to their children, but while their spouse is still alive, their partner is still alive, they want them to be able to benefit. What we do is it's possible to pass all those assets to your spouse and pass those tax-free allowances to your spouse as well, or your civil partner. And then that means they can kind of add those to their own ones. And so the effect of all of these things, 325 basic allowance, 175 for property, and then the same again for the partner that can be passed on, means that for a typical family, not everybody, for a typical family of two married or civil partnered individuals, you have a total allowance of up to £1 million. And so that's the kind of size of what inheritance tax looks like in terms of what it's taxing. It's then taxing at a 40% rate the wealth you have above that you're passing on. So who pays? Currently, about 5.5% of people we think have inheritance tax due on their death. So you may have seen this 4% number going around. The long run average, if you look over the last sort of 10, 20 years, 4% is sort of the number of people who are typically paying inheritance tax. But we think that because wealth is growing among the set of people who are kind of getting to the point of dying now, so people who are dying now are wealthier at the point they die than someone who died 5 or 10 or 15 years ago, there's actually a growing number of people who are going to be paying that. So although it's 4% just under 4% in the most recent HMRC statistics from a few years ago, we think that in the current years, years going forward, it's going to be up more like 5.5%. And that's actually not fully capturing who's sort of affected by inheritance tax. I mean, one of the reasons I think that inheritance tax is sometimes seen as unpopular is lots of people have to file inheritance tax, and so they kind of feel the pain of it, even if they're not paying anything. They have to fill in all these forms, and that's not a pleasant process. So almost half of deaths lead to those forms being filled in. But actually, in terms of people who are paying, if you think about that example I gave you of somebody who dies, they pass their assets to their civil partner, their spouse, and eventually those assets get passed to the kids. If that's what's happening, the kids are going to feel like inheritance tax was paid if inheritance tax is paid on the second death. In HMRC statistics, quite reasonably, they'll say, well, the first death didn't lead to inheritance tax. From a purely technical perspective, that's right. There's nothing for HMRC to do there in terms of tax. But as a family, you'd sort of think, well, both those deaths led to inheritance tax. And so you might want to count both those deaths as people who are paying inheritance tax. If you're to do that, it's not 5.5% who are paying it, but it's actually just under 9% of deaths that are leading to it, if you count either the person dying or their spouse dying as leading to inheritance tax. So it's slightly broader than people currently think. Second fact about it is that it's concentrated broadly in the south of England. Obviously, people all over the country can be paying it, but the south of England is wealthier, particularly in the context of houses. And so that means that that's where taxpayers are more likely to be. And David will talk a bit more about the regional breakdowns of inheritance tax and the impacts of reforms to it. And the final fact that's again often cited is that fiscally, in terms of the total tax revenue that's raised, it's pretty small. So about £7 billion. That's around the same as adding 1p to income tax rates or to VAT. It's that sort of order of magnitude. It's not nothing, but it's also not a huge amount that you're going to pay for the entire NHS budget with or something. So in that sense, some people say, well, it's not that important because it's small. So one important caveat with that fact is that actually inheritance tax is set to rise rapidly in the coming years. What you can see here is the long run trend looking back about 40 years and then looking forward the next 10 years of what has happened to inheritance tax as a share of GDP. So how what's the revenue that's raised from inheritance tax or its predecessors, so they weren't always called inheritance tax, as a share of total income in the economy. What you can see is that line is sort of bumped up and down around about 0.2%. That's sort of the long run average. It's gone up at times, it's gone down at times. You can see it started rising actually from the early 90s, and it's sort of a kind of linear trend going up and up until there was a reform in the mid-late 2000s, basically because that line was going up and it became a bit political whether inheritance tax should stay in the same form. And so there were rises in the thresholds and additional thresholds created so that more people were taken out of inheritance tax. And that led to that drop that you can see in terms of the share inheritance tax as a share of GDP. Since then, it's been rising again. You can see it sort of kind of continuously rising. The OBR predicts it's sort of going to flatten out. We think it's actually going to rise faster than they do. Our data sets are different, and what we can do is to take account of the fact that people who are dying in the coming years are actually wealthier than those who died in previous years. And when you account for that, actually, the amount of revenue that we raised from inheritance tax, if nothing changes, if we just keep the status quo, and we keep government policy in terms of the expectations of what will happen to the thresholds for inheritance tax, we expect inheritance tax revenue to double actually over the next 10 years, from about 7 billion now to about 15 billion in 10 years time in current prices, so accounting for inflation. So that's kind of the status quo. That's how things work right now. So then the question is, well, what should we do with inheritance tax? What are the impacts of reforming it in various kinds of ways? And so there's two parts to that. One is, what happens in terms of the finances? What does that mean in terms of revenue? Second part is the distribution. Who's going to benefit from it? So I'll talk about the former and then the money, and then David, in terms of the big pictures, and then David will talk to you about who benefits specifically. And so the first possible reform is the totally obvious one that's the one that's being described at the moment, which is just abolition. Straightforward, remove the tax. Well, we know it raises £7 billion at the moment. It's going on to raise 15 billion in about 10 years' time. So that's the size of the fiscal hole. If you choose not to keep inheritance tax, if you choose to get rid of it, you need to find a way to pay for that, either by raising taxes or by cutting spending somewhere. But there is a choice. There's a real choice here. If we're not raising this money, we do have to think about what that means, what the trade-off is in terms of how we're going to pay for the things we pay for. And that could be by paying for less. It could be by raising other taxes. But we shouldn't pretend that choice isn't there. And so I think any politicians who are going to make announcements about removal of inheritance tax are going to need to be clear where they think that money is coming from. And people should then judge it on the basis of, is the overall package something they're happy with? So that's what happens if you were to abolish inheritance tax. Something else you could do is, I showed you that long run average is about 0.2% of GDP. And I told you that the long run has been about 4% of households, 4% of deaths, being covered by inheritance tax. So one option, just if you were trying to scale back inheritance tax, not have it quite as large and just hold it to where it's been for a while, is just to raise the tax-free amount so that we go back to being about 4% of deaths being covered. And so you're going to see a lot of these kinds of tables like the one I've shown you here that show you what happens if you were to make a change in terms of the revenue that's raised and the ways you could do things with that revenue. So option one, or option zero actually, is to just say we want to go back to the long run average, about 4% of deaths being covered. And the way you do that is to raise the nil rate band to this tax-free amount from £325,000 at the moment to £380,000. If you're to do that, you've raised that, you've taken some people out of the tax, and you've reduced the tax that's paid by some people further up. And so that costs about just less than £1 billion. So it's not huge, but it costs something. And that's the impact of taking us to 4% of deaths taxed. Now, there are lots of ways you could think about paying for that. It doesn't have to have anything to do with inheritance tax at all. But just to give you a kind of idea of what would that look like if you wanted to take us back to 4% of deaths, but you wanted to pay for it by making a change to inheritance tax. You clearly can't change the threshold because we've set the threshold to hit 4% of people. But one thing you can do is to change the tax rate. So there's no reason at all that you should want to use inheritance tax as the way to pay for this kind of reform. But just as a kind of thought experiment, what would that look like? That means raising the tax rate for inheritance tax to 46%. If you wanted to make a reform that meant only 4% of people paid, but you wanted to not have any fiscal costs, you didn't want to either raise money or spend money on doing this, you'd have to raise the tax rate to about 46%. So that's one sort of reform that's not starting from any kind of economic principle, and it doesn't have to. It starts from the principle of what we're thinking about here is just deciding how many people should be in the tax and how much money we want to raise. And that's one set of reforms you could do. But there's a wider set of reforms that I think are really important for us to think about. And that's important. These ones are going to be important, whatever your view is of how many people should pay. The reason this set of reforms is going to be important is there are a set of problems with the current structure of inheritance tax, which means that particular asset classes aren't taxed in the same way as others. I'll tell you what that means, but that means that you end up with a set of problems within inheritance tax. So one example here is if you own a private business, or if you own shares in the alternative investment market, those kinds of assets you can pass on, subject to a few requirements, you can pass them on completely tax-free. An unlimited amount of AIM shares I would be able to pass on completely tax-free, as long as I've held them for 2 years before I die. And so that's very costly, and it's distortionary. It's not obvious why we want to encourage people to hold that form of asset, whether it's those AIM shares specifically. If it's something we wanted, why would we have that only as an encouragement within death rather than in other parts of the tax system, if that's really what we want? If you're trying to do this in the context of private businesses, so I'm, say, running a small business, what this is encouraging is actually I should hang on to that business even past the point where I can work in it or use it productively or make it grow, because I can pass it on tax-free. Whereas if I were to sell the business and just have cash and pass that to my kids, I wouldn't get this relief. And so these kinds of reliefs are problematic because they cause those sorts of problems. Similarly, agricultural relief exists exists in a way that means that if I buy up some farmland, hold on to it for long enough, I'm able to pass that on tax-free. That bids up the cost of farmland for farmers who actually want, who were there not even for the tax effect, but just want to farm it, because there are people who want to own it, not because they actually want to do the farming themselves and be a farmer, but just because they want to pass it on. So those kind of distortions are things we think shouldn't really be in the tax system. So if you were to do a reform that were to remove some of these things, one option would be just to abolish business relief. This relief that means that I can pass on a business or shares in AIM listed companies completely tax-free. And if you were to do that, you would raise about £1.4 billion. So that's like a 20% increase in the total revenue that comes from inheritance tax. So it's pretty big in that sense. It has basically no change in the share of death tax. That was, I said 5.5, it was actually 5.2 would be the right number. In the absence of this reform, it goes up to 5.3. So it's a pretty small change in the number of people who are covered by the tax, because most of the people who are covered by, who would be affected by this reform would be somewhere in the inheritance tax system already. They might not be paying they would clearly not pay as much tax currently as they would under this reform, but they're probably in there somewhere. So if you were to do that, as I said, raises 20% increase in the total revenue you get from here. You could take that 1.4 billion and use it on some other source of spending. You should use that money to cut some other tax. But if you wanted to do this and you sort of felt like you had to sweeten the pill within the context of inheritance tax, you really wanted to do a reform that was revenue neutral. So you weren't raising money, you were just making the system better. Well, one way to do that would be to raise that tax-free amount. Now with £1.4 billion, you could afford to raise that tax-free amount by more than £400,000, 415,000. And that takes that that number of deaths, number of people who are covered by inheritance tax, back below 4%. So back to kind of the long run average by doing that. So this is a reform that takes us back to where we are in terms of the number of people who are paying it. But the way we're doing it is by raising money from some people and using that to kind of raise that threshold to take some people out. The alternative would be actually just to cut the headline tax rate for inheritance tax. And in that case, you can cut the headline rate to 34%, and you would be revenue neutral still. So that's the alternative way in which you could do this. As I say, just it's worth stressing, the point here is not that you ought to do this. There's no reason you ought to give back the money in the context of inheritance tax, but it's worth just thinking out what it looks like and what it would mean. The second option that we can consider is, suppose that someone felt like that's too far. It goes too far to completely abolish business relief. There are some small businesses that, for some reason, we specifically want to make sure stay within the hands of the family that have them. Clearly that means that's not a benefit that people whose parents don't have a business already are going to get. But if politically it was deemed that was necessary to preserve, what you could do is to, say, have a capped relief. That means that as well as the £500,000 that you can pass on currently, that's a combination of your nil rate band and property, you could, on top of that, have an extra £500,000 of business relief specifically you could pass on. Now, what that does is actually to raise almost the same amount of money. It raises 1.1 billion, so a bit less. It captures the same number of people in terms of the deaths that are covered. But what it's doing is making sure that there are some people, if you only have a small business, that aren't being covered by that, aren't being affected now by that rise. And what that's doing is essentially saying, well, those people we don't want to tax them, but because most of that business wealth is actually held by people with quite a lot of wealth, it actually doesn't change the total revenue numbers that much. So that's what you can see. And you can see because it doesn't change the total revenue that much, it doesn't have a huge impact on the revenue neutral threshold that you could set, doesn't have a huge impact on the revenue neutral inheritance tax rate relative to the last option that I gave you. The third thing, just on agricultural relief, this is much harder to observe in the data, so we didn't produce our own estimates of this, but HMRC's estimates say that if you were to abolish agricultural relief, then you would raise about almost £500 million. So that's also not a trivial amount. But because we don't have it in our data, we can't kind of link it to those other measures we have. So that's the first kind of principled reform that you could do that I think would make the system much better than it is at the moment. Second principled reform would be to treat defined contribution pension pots as taxable. So when you save money at the moment into your pension, the idea, historically would be you put that money aside, it goes into your pension, and at some point you're going to retire and spend that money. That's what the point of that pension pot is. But one of the quirks of the current system is if you are putting money into a defined contribution pension pot, so you're putting it in there and it's not something that relates to what your salary is in terms of you get paid later on based on a share of your salary, but is kind of a savings pot that's tax privileged. Then what happens at the moment is when you die, that pot, if you haven't used it, can get passed entirely tax-free to your children or whoever is going to benefit from your estate. That is a kind of weird situation because it encourages people to save not for their own retirement, but to be able to pass that money on, which is not probably what we want to design the tax system to do. And obviously, it privileges savings in that form over other kinds of assets that you might have, which again, for the same reasons I related before, is not something we want to do in the tax system. So if you treat those contributions as taxable, and says 80% here, and that 80% number is because you want to account for the fact there should be income tax payable on that money as well. So you want to kind of offset that. If you were to include those pension pots in, then you raise a small amount of money. You raise about £200 million. So it's not huge in the short term, but that still doesn't stop it from being the right thing to do. But the other thing to note with pensions is that number is actually growing very fast. The contributions to private pensions have been growing a lot, or were growing a lot kind of 30 years ago, in a way that means that by now, there are people who are getting towards death who have quite sizable pension pots. And so over the coming years, that reform is going to raise more money and is probably going to therefore, there'll be more people who will feel the pain of it when you make that reform if you do it later. You probably want to do it, politicians should probably do it sooner rather than later, both to make the system better and because it's probably kind of politically easier in some ways to do that now. But in terms of total revenue right now, it's not going to raise a huge amount of money, it will just grow over time. And then the third reform that would, again, be a kind of principled reform to make the system better is to remove the kind of special treatment of property passed to your own kids. Now, this is important because, you might think, well, there's a sort of value to the family home and making sure that my children have that. But that's not how the relief currently works. If I've already sold my home and I just earmark that cash appropriately, I can still make sure that gets passed to my kids, even though the house doesn't exist anymore, even though I've sold it because I wanted to move into a nursing home. If I explicitly say in my will that the house exists, but I want it to be sold on my death so that it can be split between my many children and it can be divided up in a way that you can't with the house, that's also something that they would still get this relief. So this relief is not something that actually is rated to the family home. But the other thing to remember is that not everyone has that big family home. Some people will, some people won't. And in a society in which you make sure that those homes are passed on to the people who are the children of whoever has those homes, the kind of hidden cost is that there are people who don't have that benefit and who are not going to get that. And the point of inheritance tax, as David will discuss, in principle might be partly to try to even out some of those inequalities in terms of what you get from your parents. So if you were to abolish this nil rate band, it would raise residence nil rate band. It would raise quite a lot of money. But probably since at the moment, most people are claiming, but not everybody gets access to it. You probably want to just expand politically, you probably want to expand that nil rate band. So you're just effectively combining the special relief of property and giving it to everybody, whether or not they have property wealth specifically. And so because you're expanding that relief, so you're giving it to more people, this is a net giveaway. It's going to cost money to do. It will cost about £700 million. The share of deaths taxed as a result of this, because you're taking some people out, goes down from that 5.3 down to about 4.3. And because it costs money, if you want to do this in a revenue neutral way, you would actually not go up to combining those two bands, so reaching £500,000, but you'd go up to say £450,000. So you wouldn't, if you were just doing this reform, you wouldn't get all the way there, or you'd have to increase the tax rate. But we can do better. Suppose you combine all these three reforms. So you combine the money you get from capping business relief You could go further and actually scrap it, but you could cap it. You could include pensions, and then you could eliminate this residential nil rate band and combine it all. So if you were to do those things, that raises £4.5 billion. That's a huge amount of money in the context of inheritance tax. So it's not huge in the overall fiscal sense, but compared to a 7 billion current, 4.5 billion is pretty big. That also expands quite a lot the number of deaths that are taxed. And so you go up to a bit over 9%. But because you've raised all this money, if you were trying to do this in a revenue neutral way, what you could do is to then raise that threshold of the number of people who are paying of the amount you can transfer before you pay inheritance tax. So you could raise that threshold so that the first just over £500,000, like £525,000, could be taken completely out of inheritance tax. That would take the number of people who are covered by the tax back below 4%, so again to that long run average. And that's one revenue neutral way in which you could make the system better, not particularly aim to raise any money if that's not what you're trying to do, and reduce the number of people back to that long run average. An alternative would be to do all those reforms, that raises a lot of money, and actually just to cut the inheritance tax rate by quite a lot. So you keep all those 9% of people in the inheritance tax, but you reduce that tax rate from 40% down to 25%. And both of those reforms, whether to raise the threshold or to cut that rate, would raise would kind of be revenue neutral and would make the system kind of much more rational. So what else do we recommend? So the first three of these are the things we just covered. So we think you should abolish or at least cap business relief and agricultural relief. I said we should treat defined contribution pension pots as taxable. And the third thing I said was that you should abolish the special treatment for houses and just kind of merge them in with everything else. There are three other recommendations that we make, and there's lots of other material in the report. The three other recommendations that are kind of quite important, but that we don't, I didn't cover here. One is to rationalize the treatment of gifts. At the moment, to stop people giving sort of, a week before they die when they realize that there's some problem, we have a kind of look back period. So any gifts in the 7 years before you die are covered by inheritance tax. You have to include those as part of your estate when somebody dies. But what happens at the moment is, if you were able to give away more than 3 years ago, but less than 7 years ago, you get a reduction in the tax rate. But you get a reduction in the tax rate only if you're able to give away more than £325,000. So if you gave away, £10,000 6 years ago, you get no benefit for doing that. There's no reduction in your inheritance tax. If you're able to give away £335,000 7 years ago or six years ago, then you actually get a reduction in the inheritance tax. That top £10,000 that's above the nil rate band, you're paying a lower rate of tax on that bit. And so it kind of benefits only people who can give away very large amounts of money. That doesn't really make sense. It creates some kind of weird distortions. It's hard to explain really why you want that to be in the system. And so we think you should kind of get rid of that thing that's called taper relief. There are other things we say about gifts, but that's kind of the biggest one. Next reform, the last two reforms are not directly in inheritance tax, but they're important in terms of the taxation of the taxation at death. So one is currently, if I own an asset, it increases in value, and I sell that asset. If the increase was enough, I pay capital gains tax on that rise in value. That rise in value is the capital gain, and I pay tax on that. If instead I can afford to hold that asset until I die, then when I die, all the capital gains tax that would have been owed if I'd sold it the day before I died are completely wiped out. So the assets get passed to whoever I pass them to, but the tax is completely wiped out. And so again, this is distortionary because it encourages people to hang on to assets sort of inefficiently until the point they die, just so that they can get that tax wiped out. It's also, those large gains are going to be most common among particularly wealthy people. And so the question of whether that's what you really want to do in terms of the benefits, who's getting the benefits of that. And if you were to do that, if you were to kind of remove that and instead treat that death as a disposal event, effectively, as though someone had sold it just before they died, you raise about £1.6 billion. So again, sort of a bit more than 20% increase in the tax you're raising at death relative to the status quo. And then the final one is, I said already about pension pots and including them in the inheritance tax. The other thing is that currently, if you were to die before the age of 75, no income tax will ever be paid on that pension pot. So you won't have paid it on the way in because you saved that money free of income tax. If you were to claim that claim from that pension and start getting yourself paid an annuity, for example, you would pay income tax on it. But if it's passed on to your children or to somebody else, and you die before the age of 75, they won't have to pay income tax on it. And that's a particularly strange treatment. Again, it doesn't really make a lot of sense. It's something that will cost even more money the longer we wait for this reform. And so this is another reform that should happen. That's our set of recommendations in terms of how to make the system better and a discussion of how much money could be raised. And now I'll hand over to David to talk us through what the distributional impact of doing all these things would be.
Great, thank you very much, Arun. I'm now going to turn to thinking about who would be affected by these different reforms, thinking about their impacts across the distribution of wealth for those who live in different parts of the country, and between the children of people who are more and less wealthy. The reforms that we examine would have dramatically different impacts across the wealth distribution. First of all, thinking about abolishing inheritance tax. Arun has told us that that would be a 7 billion tax cut overall. About half of the gains from that would go to the wealthiest 1% at death. That group is people who have wealth of more than 2.1 million that they give away at death. And abolishing the tax would mean a tax cut of a bit over £1 million each on average for that group. Some of the other reforms that we are considering and analysing are involving bringing business assets and pension wealth into the scope of inheritance tax. In terms of the effects of restricting business relief, as Arun mentioned, that would have an effect primarily for those with the largest estates. We estimate that 90% of business wealth that is bequeathed is held in estates that are worth £2 million or more. So that means that really the bulk of the impact of that reform would be felt by that group with the largest estates. At the moment, there's not that many people that have defined contribution pension pots at the point where they're passing away. But in the future, these are going to become much more common, and that wealth would be more broadly spread across the distribution. And as Arun has said, because people are going to be paying into those pension pots now, some of them maybe with a particular expectation about how they'll be taxed, it would be a good idea to make any changes there as soon as possible to give people time to realise that change before they get to older ages. We also consider the abolition of the residence nil rate band, and this could be combined with raising the nil rate band, that's just the general tax-free amount, to 500,000. That's basically saying giving everyone £500,000 that they can pass on tax-free. And what that does is it equalises the treatment of those who do and don't have significant amounts of housing wealth and the children to pass it to, meaning that they can take advantage of that residence nil rate band. So what would be the effect in terms of the percentage of people paying inheritance tax under the current system and under some of the different reforms that Arun has set out? So here I'm going to be thinking about the proportion of people who pay inheritance tax by different amounts of wealth that they bequeath. And here I'm going to be considering someone as paying inheritance tax if they pay the tax themselves or their partner would pay it when they pass away. So as Arun said, we're kind of thinking about you paying tax also if you pass assets to your partner, who then passes them on to the next generation and pays tax. At the moment, there is about 9% of people overall who are paying tax on that basis. So no one with assets under 325,000 is paying the tax. But there are a few people paying the tax who have assets between 325k and 1 million. That is single people and also those in couples who are not taking full advantage of that combination of the nil rate band and the residence nil rate band, perhaps because they don't have property wealth worth that much or kids to pass it on to. Above the £1 million mark, almost all estates are paying tax because couples have exhausted that £1 million tax-free amount. But we see the amounts are not quite 100% of people paying it. And also there's actually a slight decline to 88% of estates that are worth more than 5 million, resulting in inheritance tax. What's happening there is that there are some people in these groups who are taking advantage of the exemptions for business assets and pensions and other things to such a degree that they actually take themselves out of paying inheritance tax. Now, I should say it's worth bearing in mind that when we look at this picture, while we've split the groups up in this way, because it's kind of aligns with how the tax system works, the vast majority of people are towards the lower end and are not paying inheritance tax. If there was to be a reform that capped business relief to £500,000 per person and brought pension assets into estates, then that would have the effect of bringing those largest estates that don't currently pay inheritance tax into paying the tax. At the same time, it wouldn't really have much impact on those with levels of wealth less than £1 million. Another possibility, as we've said, is to abolish the residence nil rate band, give everyone £500,000 that they can pass on tax-free. And that takes everyone with wealth of less than £500,000 out of paying inheritance tax. Also takes some people with wealth of under £1 million out of the tax, but it doesn't really do anything to change who is paying inheritance tax at the top end. But you could combine these two previous reforms, bringing people into the tax at the top end, taking some people out of tax, lower down the distribution, and as Arun said, that's roughly revenue neutral overall. It actually raises a small amount of money. Finally, here you could do or make a reform that doesn't change the structure of inheritance tax, just raises that tax-free amount that everyone can give away to 380,000. And that would overall mean that 4% of deaths result in inheritance tax being paid. Now we can see that the biggest benefit here in terms of taking people out of the tax goes to those with wealth of just over £1 million, because that combined exemption for couples would now tick up to about 1.1 million. We can also ask what these reforms would do for the effective tax rate, that is, the amount of inheritance tax that is paid divided by how much wealth people are passing on. So in line with more people paying inheritance tax, as we move through the different wealth categories up to the 2 million to 5 million mark, there are higher effective tax rates being paid. But then tax rates drop a bit for those with the very largest estates. Again, that's the product of those estates taking advantage to quite a significant degree of holding assets in forms that are not taxable under inheritance tax. If we were to put in place a reform that would cap business relief, bring pensions into inheritance tax, that would dramatically increase the effective tax rate for the very largest estates of more than 5 million. Here we estimate that the effective tax rate would go from 19 to 38%. Now we might expect that after such a reform, maybe there would be more efforts made to pursue other lines of avoiding inheritance tax. But this does show the potential scope in terms of sums that are at stake through such a reform. Abolishing the residence nil rate band does a little bit in terms of reducing effective tax rates for those with wealth less than 2 million. Doesn't change things above that. And then combining these two would involve a shift in the structure of inheritance tax that would shift the burden of who's paying towards those with the very largest estates and take people at the bottom out of the tax and reduce average tax rates for the groups with a wealth of less than 2 million. If more straightforwardly, you just increase the tax-free amount, that does reduce average tax rates across the board. But that compared to the previous reform, doing this would result in less of a cut in taxes for those with wealth of under 1 million and more of a cut in terms of average tax rates for those with wealth of over $1 million. Inheritance tax revenues are particularly concentrated in some parts of the country, in particular in London and the southeast, as Arun said. Now, that's because of the particularly high property prices there and just the fact that many more wealthy people live in these parts of the country. In this chart here, I'm just showing a kind of heat map of the rate of inheritance tax payers by parliamentary constituency. We find that 16% of individuals or their partner who are based in London will pay inheritance tax at death. And that is around twice the national average, and it's 8 times higher than the rates in the northeast of England. So abolishing inheritance tax would have a much larger effect in terms of taking people out of the tax in London and the southeast. There are also differences in the extent to which people are able to take full advantage of the residence nil rate band, which is that additional £175,000 that you can pass on in terms of property tax-free. Here I'm showing in this chart the percentage of people, so among those who have more than £500,000 in assets, the percentage of people who have housing wealth of £175,000 or more, and hence are able to take full advantage of the residence nil rate band, so that particular way that inheritance tax is set up. The ability to take advantage of that varies quite dramatically across the country. So while almost everyone in London and the southeast who has more than £500,000 would be taking full advantage of that residence nil rate band, that's just over half of those in Wales. So by rationalising the system and removing that particular privileged treatment of homes that are passed on to kids, you would also kind of equalise treatment of wealth across the country to some degree. All that said, because there are just more people with higher amounts of wealth in London and the southeast, there would be much bigger impacts of reforms that increased tax-free thresholds, including those that brought business and pension wealth into inheritance tax and used that additional revenue to raise up the tax-free amount. It would have a larger impact in London and the southeast. So here we see a big drop in the proportion who are paying more than £100,000 in inheritance tax in London under some of these reforms that we consider. And that compares to much smaller reductions in the proportion paying large sums of inheritance tax in other parts of the country. Lastly, I'm going to turn to consider the effects of some of these reforms on an inheritance tax in general on social mobility. So one of the main justifications for having an inheritance tax in the first place is to reduce inequalities between those who have richer and poorer parents. So that is to say, inheritance tax might be thought to be used to increase social mobility. The current context is that inheritances are growing quite dramatically in size compared to earned incomes. So that's one of the reasons why inheritance tax revenues are going up. But that also means that as people's resources that they get over their whole lifetimes are increasingly made up of inheritances, those inheritances are having a more negative impact on social mobility because what you stand to gain becomes more linked to your parental background. We can see that in this chart here. I'm showing for those born in the 1960s, 1970s, and 1980s, the median amount of parental wealth per heir. So that is how much wealth do your parents have divided by the number of kids that they have. So for those born in the 1960s, parents have about £90,000 per kid. That person in the 1960s might stand to inherit. That rises up to about 180,000 for those born in the 1980s, so about a bit more than doubling. But there's dramatic variation in terms of how much people stand to inherit. So within these generations, about 10 to 20% of people will receive very little at all in inheritances. But taking the 1980s born, for example, about a quarter have parents who could pass on more than 350,000 to each of their children. And because earned incomes are not growing very quickly across these generations, that growth in inheritances is driving bigger inequalities by parental background as we move through the generations. So there's this growing negative impact of inheritances on social mobility. But in that context, inheritance tax is doing very little to offset these impacts. Here in this chart, I'm showing people split by the different quintiles of parental wealth and showing average levels of wealth when people are in their 50s, which is a bit before the age that they normally would be receiving an inheritance. And we find that those who have the richest fifth of parents by that point have themselves accumulated about £800,000 on average, compared to about £200,000 for the least, those with the least wealthy parents. And then layered on top of that comes inheritances that are about £380,000 on average for those with the wealthiest fifth of parents, and close to zero at the bottom. But I can split out that inheritance and highlight the amount which is taken away by inheritance tax. And what we're seeing there is that inheritance tax in its current form is doing very little to have an impact on those inequalities in terms of inheritances received by those with richer and poorer parents. Never mind the already existing inequalities in wealth that are in place before those inheritances arrive. But it's not to say that inheritance tax could never have a large impact on the distribution of inheritances. Purely as a kind of example or exercise to get us thinking, we showed what the effects would be if we were to have implemented the system of capital transfer taxation as it was in 1985-86, uprated to today's terms. That's a much more expansive system with rates up to 60%. It would have a much more dramatic impact in terms of the amount of tax that's paid. About half of people would pay inheritance tax under such a system, but it would have more of an impact in terms of reducing inequalities by parental background. That would be a really dramatic shift away from today's inheritance tax system. And so what we're kind of saying is that to have really a substantial impact on intergenerational mobility would require a really dramatic change in the inheritance tax system. Even some of the reforms that we're considering earlier are not really going to change the picture that much for social mobility. So just to summarize then, we've seen that inheritances and inheritance tax revenues are set to grow quickly over time, and therefore scrapping inheritance tax would have a growing fiscal cost. That also means it's increasingly important that the tax is well designed, and there are several reforms that could be put in place that would improve the design of the tax, make it fairer, and could also be used to either fund other public spending or give tax cuts through inheritance tax or elsewhere. Abolishing inheritance tax would be a tax cut of £1 million for the wealthiest 1%, much of it going to those in London and the South East. Doing some of these things that would rationalise the inheritance tax system, like scrapping business and agriculture reliefs and bringing pensions into estates, would raise taxes on the largest estates and could allow the inheritance tax system to be rebalanced towards those and away from smaller amounts of wealth. But finally, in its current form, inheritance tax doesn't have a very large effect on social mobility, although that's not to say that with more radical reforms, it couldn't have an impact. I'll stop here and I'll hand back to Paul.
Great. Thank you very much, David. Thank you very much, Arun. That was a fantastic run through of a lot of material. And we have, as you might expect, a very large number of questions flowing from that, which we won't be able to get through all of by any means, but some of them are really nice and interesting. So I will start with the one voted to the top. I'll direct this one to you, Arun. Is it right to look at inheritance tax in isolation? Should we look at wider issues of capital tax reform?
So I think absolutely there are a wide set of problems in the way we tax capital in the UK. There's actually a report by colleagues of mine, Helmer and Stuart Adam, and maybe Isaac Lester as well, on that report. That came out earlier this year, looking at kind of pathways to improving the overall taxation system, including wider reforms to capital taxes. I've also done other work on doing those. I think there's the kind of combination of what do you want the ideal tax system to look like and how do you get from here to there. I think what we try to do in this report, and I think is a goal in a lot of IFS reports, is to pick off a particular area and say, how could you do things that would make this system clearly better? And that's not to say it would fix all of the problems, but if you're a politician, you're not going to be able to do all of the reforms in one kind of big bang. So the aim, I think, is in practice is going to always be to start where you are and say, how could you make the system better? And I think that's what we're trying to do here.
The next question is also, I think, a really good one, which you didn't talk a great deal about, but which traditionally we economists have been quite keen on, which is the idea of moving this from a tax based on the donor to a tax based on the donee, so the recipient of the income, which in a sense is what the purpose of, if you think there's a purpose to this tax, it's to equalize by effectively taxing in the hands of the person receiving it. I mean, it seems kind of in principle a very good idea, but is this something that is feasible in practice?
I can jump in on that.
Please do.
It's definitely feasible in practice. It happens in many countries. In fact, if you look around the world, it's the norm, really. Our system where taxes are levied on the giver is more of the outlier. That doesn't mean that it's easy to change between the systems, of course. We've already got things set up, and there's a whole process whereby we kind of levy taxes on estates, and shifting that around would be more of a shift. But just to tease out, I guess, why you might want to do it in the first place is that if the reason for having an inheritance tax is a concern with social mobility, then that's kind of a concern about, well, how equally or unequally are these amounts being, are these amounts when they're received by the next generation? And if you have a tax which is levied on the receiver, then first of all, that means that if you receive multiple inheritances from, say, lots of different people, you might be taxed more, or if you received multiple over several years, in a way which couldn't happen with a system where you levy it on the donor. And it also opens up the possibility of having the tax rate vary by your other sources of income or wealth, so that, for example, you might want to tax at a higher rate an inheritance received by a millionaire than by someone who has no other wealth. Again, that's not possible when you are levying the tax just on the estate.
Great, thank you. It is interesting, isn't it, that this is the norm in other countries, and seems to be the sort of more appropriate basis, but not really, I think, even on the political agenda here. I mean, Arun, do you have anything to add to why that might be?
No, I mean, I think a large part of it, which is I think true in parts of these parts of the tax system that are less popular, is a sort of status quo bias. On the one hand, we seem to have a lot of fiscal events at the moment over the last few years. We managed to make lots of changes to taxes, but mostly they're not focused around a kind of thoughtful, principled reform of what do we want the system to look like, and let's make some set of reforms. I mean, the last real round of that, I think, that we can say we had was the kind of changes to corporation tax that George Osborne announced, where at least whether or not you thought they were the right thing, there was a plan, there was a clear structure, there was a clear pathway for what was going on. At the moment, all the reforms that have been happening have been sort of a small tweak here, a small nudge there. And this is clearly something that if you're going to do would be a big piece of work. You'd need a set of politicians to buy into it, think they were going to do it, have the commitment to do it so that they can go through the process from this is an idea to here's all the administrative work to make that happen, and not have too many changes of minister or whatever along the way where that moves down the list of priorities for the next minister and it stops happening. I think it really needs kind of a consistency in the political system if you're ever going to make a reform of that size.
Yeah, I mean, it's very striking that we've never had any serious debate about inheritance tax reform, certainly no consultations or anything of that kind for decades, really, since it replaced capital transfer
tax. Exactly.
Back in the 1980s, and it really is in desperate need of that. Another interesting question now at the top of my list, something that a lot of people ask, which essentially say, look, if I've earned money, I've saved it, I've already paid tax on it, is it reasonable to tax it again? I think it's worth saying to some extent that lots of taxes are paid on income that's already been taxed. I mean, I earn money and then I pay VAT on what I pay, or indeed if I pay someone to come and work on my house, I've paid income tax on that money and then they pay an income tax on what they earn and so on. But I think that's but the question goes on to say, well, why not just move to capital gains tax on death, so that only gratuitous increases in wealth are taxed? Would one of you like to say something about that?
Yeah, I mean, I think it's sort of not either or. So I think there's a couple of things to say. So the first one is just, if you think about inheritance tax at the moment, the largest asset that's covered in inheritance tax typically is houses, and your house is something where the capital gains tax is not payable on the main home that you live in, and so there won't be a capital gains tax charge separately that's there anyway. There is only going to be potentially that inheritance tax charge. Then the other thing to say is, capital gains tax and inheritance tax are kind of there for different reasons, and part of the justification around inheritance tax, for people who support inheritance tax and think it should exist, they have to make the case for why you want that as something separate from other taxes that exist. And so we have other taxes on wealth like capital gains tax, and personally I think you should actually remove the fact that, and we say in this report that you should remove the uplift at death that you get currently, where if you hold an asset until you die, it's not taxed at all, in a way that it would have been taxed if you sold it a week before you died. That's kind of weird, and we should fix that. But fixing capital gains tax to make those bits of the system work isn't the same as dealing with the issue around inheritance tax, because that capital gains tax piece is saying, if the way in which you make money is not by, for example, is not only by working, but is because you own assets that increase in value, we're taxing that, the income, kind of implied income that's coming from that. Inheritance tax, as David set out, is really there for a different reason. The reason we think about inheritance tax, I mean, there's a few reasons you could have it, but one is this kind of social mobility piece, that it's about the assets you pass on. And so if I kept my money in a bank account and I had somehow managed to get £10 million, I might, having kept it in a bank account, not make any capital gain that's going to, well, would make no capital gain that would be taxable in that form. But we really think it has an impact on social mobility. If my children are able to benefit from this £10 million I can pass on, while someone else's children don't have that. And so that inheritance tax part is really there for a different reason. And as I say, a part of the case for or against inheritance tax is, do you think that reason is something that needs to exist? Do we think that social mobility is important? The other part of it, the case to make is, if you don't think that inheritance tax should exist, given that's revenue that we're raising at the moment, where is it that you think who is it that you think should be paying it instead? Because we are going to have to make a choice if you get rid of inheritance tax, either to raise some other tax, which means someone else is paying, or to not provide some benefit or some service or something else that's currently government spending. So you reduce the amount of benefits that are paid out, and that's the choice, or you don't spend as much money on fixing crumbling schools, and that's the choice that's made. And so you do have to justify that choice.
Great. There's a couple of questions now about the politics of this. It's currently a political football. How do we depoliticize it? Why does it have such political salience? I mean, I'll kick off with my views on that, and then David and Arun, if you could chip in. I mean, I think part of it is down to what Arun said right at the beginning, which is that people, I think, see inheritance tax through two completely different lenses. If you look at this from the point of view of the donor, in the way that we were just describing, it does feel like I, as the donor, have a right to leave money that I have earned as I so desire in a way that is not subject to additional tax. So I think a lot of people take that almost ethical view of it, and another group of people take the different ethical view, which is if you look at this from the point of view of the donee, then it seems like an obvious thing to tax, because it's income that, or money that effectively descends on you through no hard work or merit of your own. I think there's. I think let's be honest about this. There is also the very wealthy also have significant political power and lobbying capacity, as David and Arun have shown very clearly, reducing inheritance tax would benefit the very wealthy. The allowances and loopholes benefit the very wealthy, and changing it would have a disproportionate effect on a very small group of people who have a significant voice in politics. But I'm not sure that either of those is quite enough to explain where we are and the lack of real, I suppose, understanding, debate, and strategy on this. So do either of you have anything to add to that on the politics of all of this?
I guess a couple of thoughts in terms of, well, why might a lot of people be so strongly not in favor of inheritance tax, despite the fact that, as we've seen, very few pay it. So the first is that a lot more people think that they're going to pay it than actually do. I mean, we've made a kind of a small contribution, I guess, in trying to understand that by saying, well, look, even if an individual doesn't have tax paid at their death, then maybe they would at their partner's. But a higher proportion still think that they're going to pay the tax. So maybe they're just a bit mistaken. There's also the fact that you don't know exactly how much wealth you're going to have at death until your death comes along. So maybe it's reasonable that a lot more people think they could end up paying the tax. Another reason is that, as Arun said, beyond those who actually have to pay anything, a lot more have to deal with the paperwork and hassle that comes through at the time of death. And it can be pretty substantial. It's hard to do. It's not something to be dismissed. And so I think that's one major reason why a lot of people come away with a kind of bad taste in their mouth when it comes to inheritance tax. But yes, in addition, there are people, and kind of good, solid polling research has shown this. There's people who, even though they know or don't think they're going to pay inheritance tax, are against it on principle. So there's really a range of reasons, I think, in addition to some of the ones that Paul said.
Just to add one point on David's the first of those issues that David raises in terms of who thinks they're going to pay it. One of the things I think that's important to remember is there's actually an even larger set of people than that 9% we identified who will at some point, at retirement, have wealth that exceeds that threshold. Now, they may say, oh, I'm living in my house in London that's increased in value, and now I'm above, between me and my partner, I'm above that threshold. Now, if they actually kind of look forward to what their life is going to look like, there's a reasonable chance they're going to have to take money out of that house to pay for care home fees and various other costs. And so the wealth they have at that kind of peak point is actually not going to be the wealth that they eventually die with. But they might look at that level of wealth and say, oh, I'm at a level where I think I might end up paying inheritance tax, not thinking about actually what is going to happen over the next 20 years means that some of that money is going to get spent down. And so you sort of feel like that could catch me, even when it's actually not going to.
And the last thing was the thresholds keep getting moved up. So when you look ahead, you kind of think, oh, I'm going to be caught by this tax. But when it comes along, actually the thresholds have increased, is often what's happened.
Yeah, which comes back to that point about sort of planning and a strategy. If you had a strategy that said, here's what the threshold is and here's how it's going to change over time, so that people had some sense that, okay, sure, it's £1 million. When you look at the sort of state pension now and you think, well, okay, but I know that what I'm going to get when I retire is going to be increased by the fact that when I get that stage, pensions are increasing. We don't know if the triple lock stays in place, but there'll be some increases that are coming. It's not just what that number looks like now. But we don't have any sense of what it's actually going to look like, because although there is an announcement of what the plan is going to be, we don't really know. 10 years, 20 years, 30 years ahead, people who are in their 40s or 50s have quite a long time before inheritance tax is likely to be relevant for them. And they don't have a sense for what the threshold is likely to be at that point. And so they might feel like they'll get there and not realize that threshold is probably going to be higher by that point.
There are a number of questions here which I'm going to lump together under the broad question of behavioural change in response to inheritance tax. What do we know about, and to what extent might we worry about, for example, this leading to some people moving abroad or moving their assets abroad? Might this create a problem, for example, for farming, for farmers and how they manage their assets? Might this result in people saving less because they know that a higher level of inheritance tax will be paid? I know those are an eclectic and broad set of issues and a very difficult set, but clearly to some extent they're at the centre of debates about inheritance tax. So there's behavior in terms of avoidance, there's behavior in terms of the structure of the economy around farming communities, for example, and there's behavior around the extent to which people might change their savings behavior. How much can we say about that, and how much should we worry about that?
Maybe I'll pick off the first couple and give David the savings one. So on the first one of people moving abroad and moving assets abroad, and moving assets abroad doesn't help you. The tax doesn't depend on where the assets are. For most people, it depends on whether you're sort of taxable in the UK. Currently, that depends on whether your permanent home is the UK, this sort of domicile concept that people may have heard about because it was sort of quite political last year. If we stay with a domicile basis for inheritance tax, and even if you move abroad, unless you can show there's been a clean break with your relationship with the UK and you've acquired a kind of specific and particular relationship with the new place that you've formed, that's still sticky. You still have to pay inheritance tax. So you could 30 years ahead move abroad somewhere and think about it, but if you just moved a couple of years ago, that's still going to cover you. If we were to move away from domicile, we could have a test. So what we do currently, if you leave and you have capital gains that you might have to pay, is there are a few years afterwards for which that kind of potential liability follows you. So if you leave the UK, sell your assets and make some capital gains, and then come back 4 years later, those capital gains will have been taxable. So you can do something like that for inheritance tax. And it doesn't have to depend. We currently do for capital gains, make it depend on whether you come back, but there's no reason you ought to do that. Other countries don't make it depend on whether you come back. So we could have something that follows for some amount of time. Obviously, at some point, people really might just leave for other reasons, and we don't want to track that. But you could do something like that. So there are solutions in there, and other countries have different options. On the second thing about farming communities, I think we've got good evidence, good economic evidence on the effect of taxes on land values. And although I don't think I've seen anything specifically in the context of agriculture, if you kind of take what we know in terms of the effect of taxes that relate to land on those values of land, it shouldn't be any surprise that the specific discount that you get for inheritance tax actually drives up a lot the value of farming land. So actually, kind of conversely to, I think, maybe what some people would expect, the current structure is what's bad for farming communities, because it's fine if you're you already own some farmland and you're actually trying to get out. This is great because you can sell it, and that land is worth quite a lot. But if you're thinking of becoming a farmer or trying to expand your small holding farm, it's actually really expensive because that land is worth a lot to somebody else who has no intention of farming it. We'll have someone, they'll have someone use the land and farm it for them, but their intention is just to hold it and use it as a way of passing that asset onwards. They're willing to pay quite a lot for it, even if they're not getting much income in rent from it. That's still worth it for them because of how much the inheritance tax saving is going to be. So you would expect actually that if you were to abolish or limit the agricultural relief, that the value of that farmland would go down. That actually, that's actually helpful if you're trying to expand your farm. It's obviously not helpful if your intention was just to sell it, not increasing the value of what you have. That actually makes it easier for people who are trying to get access to those things. And then I'll hand over to David to cover savings, because I know he has lots to say.
Yeah, I guess one other point just on the kind of farm or other assets is that it should be possible, if you wanted to, you could put provisions in such that inheritance tax bills could be paid over time. There's already existing.
We have those. Yeah.
So that kind of downside should be limited. In terms of the effect on people's savings and what they do with their wealth more broadly, as ever, it's hard to be very definitive about this. I don't want to sound too certain, but the evidence that we have suggests that people are not really that sensitive in terms of how much they save to inheritance tax. So there's a bit of evidence from around the world when there's been changes in inheritance tax rates that apply to different sorts of people, and sometimes there's been kind of some assets given special status or that's been taken away. Overall, people don't respond that much in terms of how much they save. Clearly, in the UK at the moment, there are some people who are tailoring their plans and how they hold their wealth in order to make it, in order to avoid inheritance tax. So they're kind of moving it into certain types of shares when they get old. How much people would respond in terms of finding other channels to avoid the tax is really very context specific, and it's hard to be definitive. I think what we could say is that gives a reason why it's really important for, again, reform to be designed in a thought through way so that we at the same time address all of these different channels of avoidance as far as possible, so that it's not the case that we just shut down one possibility and everyone kind of funnels across to the next opportunity, but we kind of have something which is more comprehensive. So I think probably not very big impacts for most people in terms of those whose wealth is tied up in housing and in pensions. The top are probably more sensitive, but I think there are ways of dealing with that, and it could be dealt with much better if done in a coherent way.
Great. Well, let's go with a couple of last questions, hopefully a couple of very sort of straightforward ones in a sense. Do we have any sense of how many estates, what difference would have happened to the number of estates paying if the nil rate band had actually gone up in line with inflation over the last 15 years or so? And sort of related, I suppose, to what extent are your forecasts based on dependent on what happens in the housing market? I mean, if the housing market goes south in a big way, is that going to have a big effect on your forecasts?
So we don't have a number off the top of my head for what would happen if thresholds have been increased in line with inflation, but that would have, a sizable impact on taking people out of inheritance tax. That's for sure. In terms of how much does this all depend on the housing market? Yes, I mean that's a factor that feeds into this forecast, and we kind of take the Office for Budget Responsibilities forecast there. They think house prices are going to fall a bit, then rebound. It would matter, and inheritance tax revenues would be lower if house prices fall. That said, the kind of underlying trend, which is that there's more wealth coming through at death over time, that's not going to change. The value of the houses might change, but the kind of rate of increase due to that shift through of these wealthy generations is kind of going to happen and not that much changed by outlook for the housing market.
Yeah, it's a really important point to get across, is that the core thing, there will be we're taking, as David said, the OBR's forecast for what happens to house price, but really the core thing in that growth is the people who are dying just have much more in assets than the people who were dying before, and that's just a secular shift that we're seeing over time. It's going to sort of continue, we expect, as a generation that kind of grew up at a time that wealth kind of expansion was kind of much more prevalent, are getting to the end of their lives and are passing those things on either at death or shortly before. I mean, one stat just to quickly get across, I'm not sure we emphasized it enough. We emphasized that sort of big number, that 7 billion is how much is raised now, it's going up to 15. A different way to think about how big is this is just to think out the total value of inheritances in a given year and sort of divide that out across one generation of people, one cohort of people at one age. So if you take all of the people who expect to die this year and take the wealth that they will be transferring, and imagine just giving it to all 25-year-olds, so share it out equally, that's worth £120,000 to each 25-year-old. It's a staggering amount of money that will be being passed on. And so the amount of wealth that's being passed on really is huge. It's very unequally passed on, as David showed, but the numbers that we're thinking about here really are very big, even at the individual level, not just at that kind of aggregate level that we all find a bit hard to picture because it's the government money. It really, in terms of individual pounds and pence that people would get, it's a really big number to think about. And that's why it's so important that we make sure that inheritance tax is working effectively and efficiently.
That is a brilliant point to end on. I think that's a really good way of illustrating just the sheer scale of this, and actually the kind of enormous inequality in terms of what actually people end up getting, and the opportunity there that potentially there is for changing things. Very, very interesting set of presentations from Arun and David. As I said, commend the report to you, which is on the IFS website, and of course the many things that are coming out from the IFS over the next several weeks, particularly in the run up to the autumn statement. So thank you everyone very much for attending. Thank you again to the Nuffield Foundation for funding this and our other work for the Green Budget. And I hope we'll see you very soon.